You're listening to the Be Better Off Show by Kelly+Partners.
Now, Lawrence Cunningham, since 2007, has been a Tucker Research Professor at the George Washington University in the area of law. Lawrence is an expert on corporate governance, culture and structure, and has written extensively on corporate affairs in university journals and periodicals. He has published many influential books, including the Essays of Warren Buffett, Lessons for Corporate America, in collaboration with Mr. Buffett, the AIG Story with Hank Greenberg, and Quality Shareholders, How the Best Managers Attract and Keep Them. Lawrence is the Vice Chairman of the Board of Constellation Software, Inc., a Toronto Stock Exchange listed company, and Director and former Treasurer of Ocean Colony LLC, a private resort in East Hampton, New York, and a member of the editorial board of Financial History. He has served on the board of directors of Ashford Hospitality Prime, a New York Stock Exchange investor in luxury hotels, Pearl West Group, a private investment company in Vancouver, and Strata, a private technology company in Silicon Valley. A former corporate associate of Cravath, Swaine and Moore, Lawrence consults for public and private corporations and advises management and boards of directors. He's received numerous awards, including the 2018 B. Kenneth West Lifetime Achievement Award from the National Association of Corporate Directors. I'd like to simply share with our shareholders that it was a Saturday morning. I was in the butcher and I got an email, and it was from Mr. Cunningham. At first, I thought it was an email about Mr. Cunningham because I'd been reading his books for so many years and enjoyed them so much and found them so helpful. But in fact, it was the man himself. That was a terrific morning, and so I replied to that email, and that's how Mr. Cunningham ends up here today. So without any further ado, I'd like to welcome Lawrence to speak with us. Couldn't be more pleased to be able to sit back and enjoy his words of wisdom with you as fellow shareholders.
It's been wonderful to get to know you and get to know your wonderful company. I had read some of Brett's many books, almost all of them, and almost all the way through. And I particularly enjoy reading the owner's manual that the company has put together, which reflects a lot of the thought that I will try to share tonight. I admire the document. I encourage everyone to be sure you've read and studied that. Brett gave you a bunch of background on me, and so I won't belabor it. But I do specialize in thinking about capital formation, capital deployment, and corporate governance arrangements that facilitate the optimizing those activities, particularly around a system that aligns the management team and board with the shareholders, and does that through a shared sense of what it means to be a quality company and a quality shareholder. So I'll talk about both of those topics here tonight. And in talking about those two topics, I'm going to use the framework of that book, the Essays of Warren Buffett, which Warren has supported since we published it in 1996. I have annotated the slides that I'll go through with some quotes from that book, and I've put the page numbers there in case you wanted to follow along. I've always been grateful for Warren's support of the book, and also for the support of so many directors and shareholders who have told me over the years that it's really been a North Star for them, a Bible for shareholders and a real guidebook for directors. The content of the book is comprehensive. There's a quick look at it. And I'm going to zero in on a couple sections that are in part two, first about value investing, which Warren calls intelligent investing, and then about attracting quality shareholders. And I think Kelly Partners has done a really good job at that. I think the shareholder base of this company is very high quality, and I think that's in part because of what Ken and Brett have tried to do, consciously cultivate a base of long-term focused shareholders. And so there's the rest of the table of contents. You see, it's a rich, thick book, and I'm grateful for Brett and Ken for they bought copies of it to distribute to y'all. So I'm really grateful. And I hope you enjoy the book. So just to zero in first on value investing, or what Warren calls intelligent investing, he learned the basics of this philosophy from Ben Graham, famous among investors for writing the book, The Intelligent Investor. He taught Warren at Columbia Business School, and then Warren worked for Ben at his firm. And Ben wrote a lot and said a lot, but I think he contributed three big ideas, and I've just depicted all three of them. The first is this view of the stock market as being prone to swings of euphoria and gloom that results in pricing sometimes being less than value and sometimes being more than value. And Ben's idea was that the intelligent investor tries to spot opportunities when value is greater than price. And so he imagined the marketplace being a business partner from whom you can on any day buy and on any day sell. His second and related idea was only buy when you have a high degree of confidence that the price is very much lower than value. He called this the margin of safety. Warren has said those are the three most important words in investing. Take advantage of Mr. Market by buying when everybody else is selling, when being brave and bold when everyone else is fearful and scared. And the third idea at the center of that picture, he called the circle of competence, which is a common sense idea that you should focus on what you know and what you're capable of understanding with reasonable effort, and avoid complexities, distractions, and save yourself a lot of angst and money by just sticking on what you know or what you can learn with a modicum of effort. Well, that's Ben Graham's wisdom. One final piece on Ben. This is a nice cartoon. He said, in the short run, the stock market is a voting machine. People making guesses or judgments day in and day out on a daily basis. They're expressing their preferences and their hopes and dreams. And that's where you get this a lot of price value discrepancy. But over the long term, it's a way. He said it was a weighing machine. It really does sort out the quality businesses from the inferior businesses. And so, over a short period of time, you take advantage of that Mr. Market price fluctuation, and you hold through thick and thin. You'll eventually prosper. So Warren says he learned everything he knew from Ben, and maybe that's true. But I detect three additional lessons that he developed, and I've highlighted them there on the page. And I think the first big one, these are quotes from him, but the first big one is keep things simple. You don't need to hit a big home run every time. Keep things simple. Don't swing for the fences. The phrase from American baseball, that you're going all out at one time. Take your time. Think carefully. Get good returns. Avoid losing capital. And the second big one, just avoid making mistakes. If you have the least bit of discomfort with an opportunity, skip it. Well, Warren does that a lot with people as well. You may have heard him say he only goes into business with people he likes, trusts, and admires. And when he finds such a person, he gives them free rein. But in order to do that, he's extremely careful about who he appoints, who he partners with. And the slightest whiff of doubt about a person in terms of their character, their experience, and so on, he just skips them. And the third point is to focus on substance. Look at the business, look at the cash flows. Don't worry about the stock price. when you're analyzing, don't worry about closing prices. Look at the business, follow the cash flows, because it's focusing on the playing field rather than the scoreboard. Managers very often want their stock price to be higher, and higher, which causes problems. It makes it harder to compensate employees. You're paying them in overpriced stock. Makes it harder to use stock in acquisitions. You're overpaying. It sets the shareholders up and the manager himself up for a backlash when there is a correction in that inflated price. It dislocates the relationship between the investor buying and eventually selling. Luck plays a far greater role than discipline. And so the best relationship between price and value is a rational one, not a price way above value, not an inflated price, but one that is roughly correlated to business value. So here again, some nice quotes on this topic from Buffett. You've probably read, if you've read many shareholder letters, it's quite common for CEOs to make statements and encourage higher stock price. And that's certainly nothing but Berkshire has ever done. And quite to the contrary, when Berkshire's price seems to be rising above the value, Warren calls it out. And so second point there is that if a manager is trying to attract long-term investors, she should absolutely want the price to roughly equal value and not to be as high as possible, simply to be roughly proportional to value. And what Warren has always done in his communications, as he says there, is try to provide enough information about the economics of the business so that intelligent shareholders can come to a judgment about value so that the price will, in fact, roughly correlate to value. And Warren has been very conscious about who his shareholders are, and he's been very conscious about trying to communicate so that he only gets long-term focused shareholders, and he's done a phenomenal job in doing so. So that leads directly into our second topic of quality shareholders. It's useful now to cite a famous author in investing annals named Phil Fisher, who wrote Common Stocks and Uncommon Profits. And Warren cites Phil Fisher as saying, companies are a lot like restaurants. They cater to different clientele. They have menus, and customers respond to those menus. And so in restaurants, there are some menus that are gourmet and 5-star, and that kind of restaurant will attract a discriminating foodie, someone who's very cautious, careful about selecting restaurants and dining. At the other extreme, there are restaurants that serve fast food, on-the-run food, and they'll attract the clientele that just wants something simple, cheap, and easy, and eating on the run. And yet another sort of restaurant might offer something for everyone, a smorgasbord or a buffet of some kind. So each of these restaurant models is different, and you can be sure that a different group of customers will be drawn to that. Phil Fisher and Warren Buffett said companies are kind of the same way, that a company can design a menu being long-term, being focused, being candid, focusing on owners, and they'll attract a certain kind of long-term focused investor. Another company might be focused on the results this quarter and make projections that it then tries eagerly to meet and talk a lot about the quarter and the next quarter, and they're going to attract a more short-term oriented shareholder. So way back in 1979, as Berkshire Hathaway was just getting going, Warren said, I'm going to build the 5-star gourmet restaurant of companies. and I want only to get shareholders who are going to be long-term and focused. And he said, I'm going to try in all of my communications about our business, about our views on our owners, and emphasize the business, educate the shareholders about what they do, how they allocate capital, how they organize the business, their a very unusual decentralized approach, and entice intelligent shareholders to Berkshire. And I want to talk a lot about not this quarter. Berkshire never does quarterly conference calls, never does quarterly projections, never does projections at all. It's very focused on the long term. And he thought, by doing these things, these quotes are from 1983, again, very early. He thought by doing these things, we will probably get investors who share our views and will be long term and will focus on the business and not on the stock price. Warren called this cohort quality shareholders, and he succeeded in getting them. At least back in the 90s, almost all Berkshire shareholders at the beginning of the year remained shareholders at the end of the year. It was the same shareholder group. New shareholders who came in also tended to stick around. That's changed a little bit in the last couple of years, partly due to indexing funds and partly doing the pervasive short-termism. But Berkshire still has a greater density of quality shareholders than most other companies. Here's a diagram that will help clarify who the quality shareholders are under Warren's definition and the model that I've developed. We look at the time horizon and the relative concentration. And the quality shareholders have very long time horizons and relatively concentrated portfolios. Maybe not as few as 10 or 20 positions, but certainly less than 50 or 80. At the other end of the spectrum are transients, people who buy and sell very quickly. I have no intention of holding for the long term. Nanosecond traders, algorithmic traders. Then there are the indexers who may hold for a long time, but they never concentrate. This cohort simply buys thousands of stocks, whatever are in the index. So they may be holding for long term, but they're not focused. They're not studying individual business. They're not the kind of stockholders that Warren had in mind that he wanted to attract to Berkshire. Now, again, these days, it's hard to avoid indexers. Gosh, at least in the U.S. equity markets, indexers own as much as 40% of all public equity. That includes about 25% who advertise that they're indexers, who say, we're just going to buy every stock in the Russell 3000. And it includes closet indexers. That is, these are investment managers who claim that they're stock pickers, but they actually just deliver they buy the index too and just deliver the index. 40% or so are indexers today, and another 40% or so are traders, are short-term oriented. That figure is looking at investors whose whole average holding period is less than 2 years, and a big chunk of that is even less than a year. And so it's just a lot of churning, a lot of trading activity. So that cohort is just not around. And so again, not a quality shareholder, not what Buffett was trying to get. It's only about and then activists are in a special category. Shareholder agitators, they may actually be. Some of them are long-term, some of them are very focused, and so they would qualify as quality shareholders, but not all of them. There are some very short-term, in and out activist shareholders, and so they may or may not be quality. But the quality shareholder cohort, at least the U.S. public markets, is pretty small, 15% perhaps, and yet they are enormously valuable to a company. Let me explain that a little bit more, and let me stress too that this analysis is not to criticize or denigrate any sort of investor. All of them add some value. They all provide capital for one thing, and then they each contribute something different that's valuable. Indexers, for instance, enable millions of people to deliver, to get the market return with very little risk and at relatively low cost. Transients provide liquidity. They enable people to sell when they need to. So even quality shareholders will sometimes need to sell, either because of business deteriorates or because of their own financial needs. And so transients provide that depth, that liquidity. And activists promote managerial accountability, even those who are maybe short term. And so everyone contributes something, but the quality shareholder contributes things that others do not. And I've just given a few examples on that chart, but let me elaborate this set of benefits a little more fully. On the corporate viewpoint, quality shareholders can discourage overzealous activists, those activists whose strategies are really short term and maybe damaging to a company. And the quality shareholders can discourage that sort of behavior. If a company has a significant block of quality shareholders, an activist will think twice about pouncing. And I've got a bunch of stories in my quality shareholders book about how even when some activists targeted a company with quality shareholders, the company was able to consult the quality shareholders and enlist them to help defeat the activists. Quality shareholders can counter the enormous power that proxy advisory services have. Organizations like Institutional Shareholder Services will often advise institutional investors on voting using general formulas that may or may not make sense for particular companies. Quality shareholders do their homework, they understand the particular companies, and they make voting decisions based on substance. And so that can offset some of that formulaic voting. And third, they offset short-term pressure. If the manager has overwhelmingly transient shareholders, then you can be sure they're going to try to hit quarterly targets and they might change their business decisions and strategies and focus more on the short term. But a manager that is blessed with a large cohort of quality shareholders can look out over longer periods of time. From a market perspective, an abundant population of quality shareholders will help produce more rational pricing, will help get that price value relationship just about right. And that will then enable a company to use its stock to pay employees in compensation, to make acquisitions, and to encourage long-term ownership. There are personal advantages to having quality shareholders in a company. From a manager's perspective, they supply a brain trust, intelligent, thoughtful, informed people that a CEO, CFO can call when facing challenging decisions, or can call when an activist presents herself that's unattractive. But on very on fundamental issues of business judgment, it's useful for a CEO to have a thoughtful shareholder to consult as a sounding board. Indexers are not available for that. Transients are certainly not available for that. We've done a lot of empirical work on what happens to companies that have high or low densities of quality shareholders. And one thing we found is a correlation between a high level of quality shareholders and long CEO tenures. So it just makes the CEO job more attractive and more stable. And I think that's because the third thing under that list is it's enjoyable. It's more fun to be working with people who understand your company and want to stick around than it is dealing with indexers who really don't know your company and transients who really don't care about your company. And finally, under performance, we've done a lot of empirical work around whether investors who follow the quality approach outperform and whether companies who attract them outperform. And the answers in both cases are yes. And we've done empirical work on the investor side that builds up off of extensive work done by a number of scholars in the United States that show that an investment strategy that combines patience and focus can systematically outperform markets and indexes. And on the company side, we ranked 2,070 companies by their degree of quality shareholders, and then picked a portfolio of the top 50 and the bottom 50. And the portfolio of the top 50 outperformed by 200%. And we looked at this and sliced it and diced it in several different ways. And so our data pretty strongly supports the idea that companies that attract quality shareholders outperform. And so with that, I want to turn and invite any questions that you may have. And again, I want to thank all of you and thank Brett in particular for inviting me to join you here at your meeting.
Terrific, Lawrence. Thank you so much. And as always, I've never spent a minute with Lawrence that I didn't learn something from. So that was really tremendous. We've got the chat function operating. If anyone's got a question, please pop it in the chat function. And while we wait for a question, Lawrence, I'd ask you, when you did that analysis of companies with quality shareholders, was it in the US market?
Yes, what we've done so far is almost entirely in the North American market, so it includes Canada as well. But then we have begun to survey other major markets, and started with European markets, Germany, the UK, and France, and in Asian markets, we looked at Japan and China, and just started in Australia. And so our probing is highly preliminary, and there are differences in corporate life in all of these places. So you have, in Germany, it's much more common for major banks to be major shareholders and lenders to companies. And so they've got different time horizons, different focus. In France, there's still significant public ownership and state ownership of businesses. The UK is most like the US and it's more like Australia. Japan, they continue to have the sort of old Keiretsu kind of model of interlocking ownership, and so these differences end up making the our model. We have to adjust the model a little bit for horizon and focus. But that said, when we look at U.S. investors in all of those areas, the behavior is similar. The proportions are similar. What they do and how long they hold is similar. So we think we aim to have. We're doing deeper research. We're continuing to work on that. It's highly preliminary, but and the results will be a little different, but just because of different cultures. But I think that our basic thesis will hold up.
Terrific. I've got a question here from Tim Allerton. How does the Kelly model fit into the Buffett model? How would you look at our business?
I think it fits in quite strongly. There are some differences. Obviously, this is a focus. Kelly's a focused business, focused on accounting products, focused in a particular geography, whereas Berkshire is opportunistic and makes investments in basically every sector and all around the world. But many of the principles are quite similar, and I'd focus on the Kelly Owner's Manual, which articulates a dozen or so fundamental beliefs or tenets, and many of those correlate directly with the Berkshire model. And so take a look at those. Other things that relative judicious use of leverage, let's say, focus on return on invested capital, a a preference for decentralized, autonomous business models. So when Kelly acquires an accounting firm, obviously the parent, the holding group, provides lots of knowledge and shares lots of best practices, but the managers enjoy considerable autonomy, and that kind of belief in sort of human achievement. I think the reason Buffett has such a model is because he believes that people will do better when they're trusted. They will perform at higher levels when they have a sense of control and power over their business and their lives. And so I do think there are substantial commonalities, and it's one of the reasons I think that Kelly has attracted a high density of quality shareholders.
Terrific. I've got a question here that is, do most of the Buffett investment fundamentals still apply in today's equity markets, i.e. new and existing tech stocks?
Yeah, they absolutely do. And he's been doing this for 60 plus years and writing about it. And those 60 plus years have seen enormous change, enormous volatility, tremendous innovation. And so there's a feeling today that we are experiencing innovation at a far more rapid pace, and that might be true. And we're certainly facing some considerable political, social, and economic challenges, and not to mention the pandemic. But even so, there's been innovation over all those 60 years and turmoil over all those 60 years. And so if you take a look at those fundamentals about how stock markets or bond and real estate markets do, how they fluctuate in price, how price can deviate from value, how important it is to focus on business fundamentals and to think about cash flows in the next 5 or 10 years. None of that's changed. And wars, presidential resignations, droughts, famine, the plague don't alter those fundamentals. So so the world changes all the time. It's changed a lot in 60 years. It's changed a lot in the last 6. But those fundamentals are timeless.
Terrific. And final question, as we're running out of time, Lawrence, which is great. But I see here, like, being on the Constellation Software board, do you see any similarities between what Mark Leonard's done and what we're trying to do at Kelly+Partners?
Yeah, I'd say, thanks for that question, because I'd say Kelly might be closer to Constellation than to Berkshire, certainly in that sense that at Constellation we're almost exclusively focused on one industry, vertical market software, and we've developed tremendous expertise in that area, just as Kelly commands that expertise in both in operations and in investing in the accounting space, and both share a focus on return on invested capital. Both are very focused on that autonomous, decentralized approach. Both very focused on sharing, learning, and then sharing best practices. Some of the training materials that Kelly have are just embodiments of sharing best practices. So yeah, I do think these two companies have a great deal in common.
Terrific. Lawrence, I want to thank you so much for your time today. I've learned again, I think repetition is the mother of all mastery, and hearing the principles again and getting another angle and some more context is absolutely fantastic. I really appreciate your time. Can't thank you enough for attending today and sharing your wisdom with our shareholders. We're working very hard and have been inspired by Lawrence's book, Quality Shareholders. If you haven't read it, go to Amazon and buy yourself a copy. It will help you understand what we're trying to do with our shareholder base at Kelly+Partners and help you in your whole investing life, I'm certain. So once again, from everyone here at Kelly+Partners, Lawrence, thank you so much for attending and sharing with us today.
Thanks for listening to the Be Better Off Show. If you enjoyed this episode, don't forget to rate and review on Apple Podcasts.
Have a great day.